Labor Day, the unofficial end of the summer, has just passed. And that's a perfect time to look at newly released government data for August on the employment situation. Both the employment data and inflation data for August are okay, but just okay, and that's likely to delay any hike in interest rates until the fourth quarter. The August unemployment rate held steady at 4.9%. That's not quite as low as was reached in the last two expansions, but this expansion is still rolling along. The government also reported that 151,000 new non-farm payroll jobs were created in August. A healthy gain, but nothing spectacular. Economic fundamentals, like the jobs data, drive the economy, which in turn drives profits at companies, and ultimately, that is what drives the Standard & Poor's 500 stock index. Applying the historic price-to-earnings ratio of 17 to the latest earnings forecasts for the S&P 500 for 2016 and 2017 results in the dashed red line. This is not a forecast or prediction. It's simply a calculation to illustrate a path that the S&P 500 could reasonably take given the current outlook for economic and earnings growth, coupled with continued expected low inflation. This kind of analysis of economic fundamentals is obviously important to investors and is straightforward. But a deeper dive into the employment data unexpectedly reveals that the government report that gets all the headlines is actually not all that important. The 4.9% unemployment rate, officially known as the U3 Index of Unemployment, gets the headlines in the media. But the government's U6 Index of Unemployment has more influence over the Federal Reserve's monetary policy. The U6 Unemployment Index includes a group of unemployed, categorized by the government as discouraged workers, those who are not counted in the labor force but are available for work, and those who have looked for a job in the previous 12 months but had not searched for work in the 4 weeks before the survey. This group of discouraged workers are unlikely to look for work because they either believe that no jobs are available or believe that there are no jobs available for which they would qualify. The downward slope of both indexes has flattened, and both would have to head considerably lower before meeting the Fed's employment target. This makes any Fed rate hikes likely to come in small, quarter-point increments over an extended period. Meanwhile, another fundamental driver of the Federal Reserve's interest rate stance was also released just before Labor Day. The inflation rate, as measured by the Personal Consumption Expenditure Index, or PCE deflator, came in at 0.8%. The core PCE deflator, which is influential in determining Fed interest rate policy, came in at 1.4%, well below the Fed's target of 2%. The Bureau of Labor Statistics employment data for August indicates that the labor force participation rate has experienced an important stage in a cyclical trend. Discouraged workers are re-entering the labor force. This explains why the unemployment rate, at 4.9%, has flattened and not continued its downward path, despite healthy job gains. This is a positive development, signifying a cyclical stabilization in the labor force participation rate. Putting discouraged workers back to work for a sustained period is likely to lead to good things, like lower crime and poverty rates. That could happen if this economic expansion, already one of the longest of the last century, continues and gains strength. We hope you had a great summer and are most happy to report that, as of Labor Day 2016, things have been looking up for our nation's discouraged workers.